Right now, Opendoor Technologies, ticker OPEN, is trading at $7.05, and it is having a very active morning, up 3.37% on the day. The stock has already seen a wide range, spiking as high as $7.29 earlier in the session before pulling back, all on very heavy volume that's already approaching 40 million shares. Now, the immediate assumption, the one that most of the market makes, is that this pop is just another volatile day for a stock that is seen as a simple leveraged bet on the housing market. The expectation is that if mortgage rates tick down, Opendoor flies, and if they tick up, it collapses. But that view, that simple narrative, is completely missing the real high-stakes drama happening under the surface. The reality is that this company is at the center of a fundamental identity crisis, pivoting its entire business model away from what defined it, while simultaneously becoming one of the most embattled, heavily shorted, and discussed meme stocks of the year. The fight over Opendoor is no longer just about the Federal Reserve. It's a war over whether this company's core concept is viable, and the data shows the battle lines are drawn. Let's establish the common ground, the story everyone believes. For years, Opendoor was the poster child for the iBuying model. The narrative was that its sophisticated algorithms could buy homes from sellers instantly, hold them, perform minor repairs, and flip them for a small but consistent profit. It was presented as a high-tech logistics company disrupting the slow analog real estate brokerage industry. When interest rates were at zero and home prices only went up, this model looked brilliant. And so the current expectation for most retail investors is that Opendoor is just a coiled spring. They are waiting for the Fed to cut rates, for 30-year mortgage rates to fall from their painfully high perch, and for the housing market to unfreeze. The moment that happens, the thinking goes, Opendoor's business comes roaring back, and the stock, which has seen an incredible run this year, will continue its ascent. But that is a dangerously simplistic way to look at this company. The reality is that the 2022-2023 rate hike cycle didn't just slow Opendoor's business, it nearly broke its model. When the market turned, those sophisticated algorithms were caught holding billions in inventory that was declining in value. The company was forced to liquidate homes at massive losses, proving the bear thesis that iBuying was only a bull market phenomenon. This existential threat has forced a profound strategic pivot. Opendoor is now aggressively shifting to what it calls an asset-light or capital-light model. It's focusing on its marketplace, on partnerships with builders, and on providing its software and services to agents rather than primarily using its own balance sheet to buy thousands of homes. This pivot is ironically a validation of the move Zillow made back in 2021 when it exited iBuying, admitting it couldn't accurately price homes. This pivot is the entire story, and the market is deeply, fundamentally divided on it. The bulls see a company that survived a near-death experience and is emerging as a more resilient, diversified real estate tech platform. The bears see a company that has abandoned its primary disruption thesis and is now just a low-margin service provider still burning cash. This strategic confusion is what's driving the volatility, far more than the daily moves in the 10-year Treasury. We saw this tension play out perfectly in their last earnings report. In the second quarter, Opendoor shocked the market by delivering its first quarter of positive adjusted EBITDA since 2022. It was a massive proof point, suggesting the new leaner model could work. The stock ripped higher on that news. But in the very same report, management guided for the next quarter, Q3, to see a significant sequential drop in revenue and a return to adjusted EBITDA losses. This is the expectation versus reality whiplash. They proved they can be profitable, but they immediately signaled they can't sustain it yet. This brings us to the most critical factor influencing the stock price right now, the massive short interest. Opendoor isn't just a housing stock, it's a battleground. According to the most recent official data from NASDAQ, a staggering 21.24% of the company's entire free float is sold short. That is an enormous crowded trade. over 150 million shares are being held by short sellers who are betting with conviction that this stock is going lower. They believe the asset-light pivot is a desperation move, that cash burn will continue, and that the company's valuation is completely detached from its future earning potential, which analysts are wildly divided on. You have some firms, like Morgan Stanley, recently raising their price target, while the consensus target from other analysts remains shockingly low, with some projecting the stock is worth less than $2. Now, for investors watching this, it's crucial to understand how to interpret this short activity because it's not as simple as just high short interest means a squeeze is coming. You need to know what to look for. You can find the short interest percentage on most major financial sites, but the next more important metric to track is the cost to borrow rate, which is the fee short sellers must pay to borrow the shares. You can find this data on more specialized platforms like Fintel or Ortex. Here is the critical insight. Despite the 21% short interest, Opendoor's cost to borrow rate is currently very low, under 1%. This tells us something very important. It means that even though the trade is crowded, there is still a massive supply of shares available to lend. The shorts are not in a panic, and it isn't expensive for them to maintain their positions. The squeeze narrative that dominates retail forums is at this moment mostly just a narrative. The real signal to watch would be a sudden spike in that borrow fee. If it jumps to 10%, 25%, or 50%, it means the available shares to borrow are drying up, and that is when the shorts get trapped and a squeeze becomes a mathematical possibility. Another metric to watch is the days to cover. For Opendoor, this is currently low, around 2.08 days. This means that given the stock's high average volume, the shorts could theoretically buy back all their 150 million shares in just over 2 trading days. A low days to cover ratio actually works against a sustained squeeze, as the shorts can exit quickly if they need to. What's your take on this setup? Do you think the 21% short interest is a sign of smart money correctly identifying a broken model, or is it a massive pool of future buyers waiting to be forced to cover? Comment below. The discussions on Reddit and X are intense, with many treating this as a meme stock and coordinating around its squeeze potential. But investors must be extremely careful. Chasing a stock only because of its high short interest is a very high-risk strategy. The company's fundamentals have to actually improve to force the shorts to close their positions at a loss. Otherwise, you are just providing liquidity for them to exit. So, where does Opendoor go from here? The path forward is entirely dependent on this strategic pivot and the macroeconomic environment it's happening in. Let's frame the outlook. The bearish reality is that 30-year mortgage rates remain stubbornly high, perhaps even above 7% for the foreseeable future. This keeps the lock-in effect in place, where existing homeowners refuse to sell and lose their 3% mortgage rates. Transaction volume in the housing market remains frozen at historic lows. In this scenario, Opendoor's asset-light model fails to gain traction. The revenue from partnerships isn't enough to cover its corporate overhead and interest expenses. The cash burn, which was a major concern for years, accelerates again. The company is forced to raise more capital, heavily diluting existing shareholders at terrible prices just to survive. In this world, the 21% short position is proven right, and the stock heads significantly lower. The bullish expectation, the one that is clearly driving today's 3% rally, is the exact opposite. This scenario assumes that the Federal Reserve has finished its hiking cycle and that economic weakness in 2026 forces it to begin cutting rates. Mortgage rates fall back towards 6% or even 5.5%. This breaks the lock-in effect, and a wave of pent-up housing supply and demand hits the market. In this world, Opendoor is perfectly positioned. Having survived the downturn, it operates a leaner, more resilient dual model. Its core iBuying business, though smaller, returns to profitability in a healthier market, while its new high-margin asset-light marketplace captures a huge share of the returning transaction volume. The positive adjusted EBITDA from Q2 becomes the norm, not the exception. The shorts, seeing this fundamental recovery, are forced to cover. The 150 million shares are bought back, and this, combined with new bullish investors, sends the stock parabolic.
But the most likely path might be a frustrating middle ground. Rates dip slightly, but the housing market just muddles along. Opendoor survives, but it never thrives. It successfully transitions into a software and services company, but it operates as a niche player, a shadow of the grand disruptor it once was promised to be. It achieves bare-bones profitability, but the high-growth story is over. In this case, the stock would likely be range-bound for years, bleeding off the volatile meme stock premium it currently holds. Ultimately, when you look at Opendoor, the expectation is that you are buying a simple proxy for the housing market. The reality is that you are investing in a deeply complex, high-stakes turnaround story. You are betting on a management team executing a difficult strategic pivot away from its core business, all while fighting a two-front war against a frozen housing market and one of the largest short seller contingencies on Wall Street. The question is not just if the housing